On Point with Craig's Investment Partners.
All right, good morning, everybody. Remember, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. And all investments are subject to risk and none are guaranteed. So before you make any investment decisions, we always recommend you contact an investment advisor. And you can find more about our services in that regard at our website, which is craigsip.com. All right, let's look back at last week, and it was a more difficult week for global share markets. We have seen the rally that has been taking place for a little while now just take a bit of a breather, and most markets were down last week. We had the US S&P 500 fall 1.4%, so that snapped the winning streak of 5 consecutive weekly gains, so 5 up weeks, and now we've had a down week. And the index actually did hit its highest levels since April 2022 in the week before last. So the US market has had a very strong run, but it was just off the boil a little bit last week. The UK and Europe both down 2.4% and 2.9%. Aussie shares down 2.1%. And the local NZX 50, as is often the case during difficult times, held up better and slipped just 0.5%. So as we head into the end of the June quarter, this week to go, and it will mark the halfway point of the year. The quarter is looking generally solid for most share markets, at least in a New Zealand dollar sense. So the US market's up about 5.8%, 7.8 in New Zealand dollar terms. UK and European shares are both down slightly, but when you account for the currency moves, because the Kiwi has fallen against the euro and the pound, both of those sort of move into positive territory. The Aussie market, similar story, down ever so slightly, but the currency's moved in our way and we're up about 1%, and the local market's down about 1.2% for the quarter. So sort of a mixed bag. That's for the quarter. And for the first half of the year, all of those markets that I've mentioned are in positive territory. Some of them quite significantly. The US market, for example, up more than 13%. Or up more than 17% in New Zealand dollar terms. So it has been a pretty good first half of the year, but as I mentioned, the rally has lost some steam of late, and I think it's really just reality setting in. And we have seen some more aggressive moves from central banks in various parts of the world over the last few weeks. Australia, Canada, Switzerland, England, all of those regions have seen their central banks increase interest rates by either more than expected, or they've guided to more interest rate hikes on the horizon. So even though in New Zealand and the US we feel like we're probably done or close to done, some of those other countries still have been playing a bit of catch up. And it's also dawned on people that maybe these interest rates aren't going to fall as quickly as people would have hoped. We've also seen some weaker economic data, which is just a reminder that we still haven't seen the full economic impact of the much higher interest rates and the speed with which they've moved up over the last 12 or 18 months. So we had some PMI releases late last week. I'll talk about those more specifically shortly, but they were a little on the soft side. We also had weekly jobless claims in the US, which came in a little higher than expected. And they're still sitting at the highest levels we've seen since October 2021. And if you do a 4-week moving average, it's at its highest levels since about that same period, about the highest since October, November 2021. So that sort of tells you that it wasn't just sort of 1 week or 2 weeks, an anomaly in the data. You've seen a sort of a consistent easing in the labour market, which is obviously good from an inflation perspective, but it's also telling you that the economy is just starting to soften. There was a few other things as well. We had the Kansas City Fed in America does a manufacturing index that fell further than expected, and it's now sort of at levels where This series started in 2001, and I don't think it's ever been as low as it is without there being a recession sort of on the horizon. So that's just pointing to weakness ahead. We had the conference board in the US, their leading economic index came out, fell for the 14th consecutive month. So there really was just a range of things that saw investors get somewhat risk averse. On the interest rate front, not a lot of change, to be honest. US 2-year treasuries rose slightly. They're sitting at 4.74. The 10-year yields was actually marginally lower, 3.7. In New Zealand, our interest rates pushed up ever so slightly, but not too much. The 5-year swap rate is at about 4.7% or just shy of those levels. Fixed income's been a pretty good performer this year. The NZX Corporate Bond Index has risen 2.8% so far this year, so that's pretty good performance for just the first 6 months of the year. And in fact, that's a better performance than we've seen from the share market. So I still think bonds are very much worth a look for investors. And if you do hold the view that the Reserve Bank is done or close to done with their interest rate hikes, and if you also believe that there's potentially a bit of economic weakness still to come, then that would suggest that the future is bright for bonds as an investment class. So that's something I think a lot of conservative investors, a lot of income investors, or balanced investors that are just looking to sort of protect themselves from future uncertainty, there is probably some value there. Talk to your advisor. Obviously, this isn't personalised advice. Anyway, let's run through some of the key events from last week. Dairy prices in New Zealand, flat auction, so there wasn't any change there at the headline level. Whole milk powder saw no change. That's one of the most important products for us. Skim milk powder was down, butter was up, so sort of some swings and roundabouts. But I think there was generally a little bit of better than people were expecting. But dairy prices are still down about 5.5% this year and about 25% below where they were a year ago. So you're still looking at that softer outlook for the farming sector in terms of the dairy payout, and the Fonterra payout forecast range has got a midpoint of about $8. So that's a little lower than the previous season and the season before that. And I think I've said, in recent podcasts, $8 is not what it used to be for the farming sector, because you've seen fertilizer prices and wage pressures and lots of other input costs have been going up, and we've obviously had the rise in interest rates. So for farmers that have some debt against the farm, they will have faced increasing costs on all fronts. And then you've got the weather that they've got to contend with in various parts of the country. We're seeing it over on the east coast of the North Island at the moment, and that has been something we've seen far too much of over the course of this year. So I do feel for some of our agricultural sector clients and listeners, and just farmers in general, because some of them have had a tough time of it. International data, we had the flash PMIs for June, so these are activity indicators. All of them remained in expansionary territory, so all of them stayed above 50. 50 is your break-even level that sort of separates contraction from expansion, so that's good. However, there was a clear trend of slowing activity. So Australia and Europe pretty much hit stall speed. They're pretty much only just sitting above 50, barely growing at all. The UK and Japan looked a little bit better, but they still slipped to, it's a 3-month low in the UK, a 4-month low in Japan. There's still a lot of divergence between the manufacturing sector and the services sector, so that's something we need to keep a close eye on. Inflation indicators look generally headed in the right direction. US firms raising selling prices at the slowest pace since October 2020. Average input costs across the European factory sector, they were dropping at the steepest rate since 2009. So, there's some good signs there. However, you are getting that slowdown in growth that is happening at the same time. So it's very much a double-edged sword. The Bank of England. This was the big news last week, and this was probably the biggest market event. The Bank of England surprised financial markets with a 50 basis point interest rate hike, and that was its 13th consecutive increase. Takes the policy rate over there to 5%, which is the highest since 2008. Back in that lead up to the GFC, it got as high as 5.75, so it's approaching those levels. Everyone had expected an increase, but no one expected 50. Everyone expected 25. I don't think there was any economists that were expecting 50 basis points. So that really did shake markets. The committee voted 7-2 in favour of the move, and it's probably not going to be the last one because they have got an inflation problem that they need to get under control. In fact, a day before that decision, I think that came through on Thursday night, our time, Wednesday night, we had the latest inflation data, and consumer prices rose during May at an annual rate of 8.7%. So that's for the year. Annual inflation rate at 8.7. People were expecting it to slow to 8.4, but it stayed at the same level as we saw in April. So higher than expected, still much higher than the Bank of England would like. Core inflation also rose to 7.1. So the headline actually just went sideways, but the core inflation actually went up, which is not good either. Core inflation sitting at the highest level since March 1992. So they've definitely got an inflation problem, as we all have, but theirs feels a little bit more persistent. It's a range of issues. They haven't really been able to get the inflation under control ever since the Ukraine war broke out. And that sort of caused lots of disruption across energy prices and so forth. So they're still sort of feeling the effects of that. I think there's still probably a few lingering sort of impacts of Brexit and sort of the COVID stuff. They've got a very tight labour market, and the services sector in particular is seeing very high wage pressures. So, it's a range of issues, essentially the same issues that many countries are facing, but the Bank of England just seems to be having a more difficult job pushing things down. So 5% policy rate, and it will go higher. Financial markets see the Bank of England policy rate peaking as high as 6.25 in early next year. So 6.25. That's where markets are at, and we haven't seen their policy rate get to that level since the 1990s. So that would be well above what we saw in the lead up to the GFC and so forth. So we'll just have to wait and see how things play out. The next move is likely to come in early August. That's when they next meet. And at the moment, markets are leaning towards maybe another 50 basis point move. So that will really be creating problems for borrowers in the UK, and for it's causing sort of the market to suffer as well. I guess what I would say there, because I know a lot of people have got UK investments in UK shares, a couple of offsetting factors. The first one is that obviously the British pound has risen on the back of higher inflation, higher interest rates, and expectations of more interest rate increases. So you've got the pound against the New Zealand dollar. It's at about 48p or something at the moment, and we started the year worth about 52, 53. So the Kiwi dollar has fallen almost 8% against the pound this year, which is a sharp fall. So even though the UK share market has been pretty subdued, it's done nothing all year. Because the pound has moved as much as it has, New Zealand investors would have actually got a reasonable return on their UK shares. So you're getting that offsetting factor from the moves in currencies. And the other thing I would point out is that the FTSE 100, which is sort of the main UK share market index, it's dominated by multinational companies where the vast proportion of their revenues actually come from outside the UK. So they don't mirror what's happening in the UK economy very well at all, because they're all global businesses that are exporting all around the world. And, it's the companies like Diageo and Unilever and all of those sort of consumer staples businesses, Rentokil, lots of great businesses over there. So don't be surprised if the UK share market actually is able to perform better than you might think it should, given the challenges around inflation and what that could mean for the economy and borrowers and so forth. Because a lot of those companies that are the dominant ones on at least that headline index, you go further down the tree into the smaller companies, and they're much more linked to the domestic economy. But those bigger ones are very much global businesses. So they're somewhat insulated from what's happening domestically in the UK. The higher pound might be a drag for them because they're all exporters, but then as a New Zealand investor, you sort of get that back in the other direction. So ironically, the UK market hasn't been as terrible as you might think, even though those are some quite dramatic moves that I'm talking about in terms of what you're seeing in terms of inflation and interest rates. All right, looking ahead, we have got US inflation. We've got the personal consumption expenditures index for May. This will be out on Friday. This is the Fed's preferred inflation measure. We would expect it to continue slowing at the headline level, although we would expect core inflation to remain higher than anyone would like. That's what we've seen in the regular CPI. So I think you'll see the same again. The annual inflation rate in terms of the headline PCE is expected to slow to 3.8%, which is the lowest we've seen. Well, if that happens, that'll be the lowest since April 2021, which would be fantastic. You know, we're down in the threes now. That is awesome. That is a real momentous occasion that we're back in the threes. However, the core PCE, which is probably what the Fed is watching more closely and more worried about, not expected to change. It is expected to just remain stubbornly high at 4.7. So certainly not in that UK sort of zone, but it's been sort of sitting there for the last 6 or 7 months, and we haven't really seen a whole lot of change. The core has come down. The headline has come down because you've seen some of those volatile, quite cyclical categories like energy and oil prices and food prices come down. But the core PCE, which is more of those wages and the services sector and some of those more structural elements of the high inflation, that has stayed high. So there'll probably be some good news and bad news in that release, which we will get on Friday. So that's probably the key one. We've got the PCE in the US. We've also got the latest consumer price index inflation figures in Europe. Those are out on Friday as well. Other international releases to watch, we've got some PMIs out of China. So we had those PMIs that I mentioned from all those other major regions last week for June. We'll get the Chinese ones this week at the end of the week, Friday afternoon, 1:30. They'll look okay, but I expect they will slow from what we saw last month. China is facing a few challenges. They've got that softness in the manufacturing sector that you're seeing in many other parts of the country. They've obviously got some issues with the property market, which is in a bit of strife, and they just haven't seen things rebound to the degree that many were hoping for as the economy has reopened this year. So that's something we'll be watching. Not expecting it to look fantastic, if I'm honest. No major central bank meetings scheduled, so we've got a bit of a breather there after a flurry of activity. The other one that was out last week was the Swiss National Bank. We had them come out and raise interest rates last week, which was as expected, but the language was quite a bit stronger about further increases that they might need to push through in the months ahead. So you can add them to the list. We had that in Australia, we've had that in Canada, had that in England obviously last week, and the SMB as well in that same boat. But no meetings this week. However, what is happening is the European Central Bank is holding a forum in Portugal early in the week, Monday, Tuesday, Wednesday. And there's a panel discussion taking place on Wednesday that will be closely watched. It will have all the big guns, Jerome Powell from the Federal Reserve, Christine Lagarde from the ECB, and the governors of the Bank of Japan and the Bank of England as well will be there. So that will be very closely watched by investors, that panel discussion on Wednesday. The theme of this forum is macroeconomic stabilization in a volatile inflation environment. So that's what is on everyone's mind. So we'll be watching that closely, and it'll give us a bit of more guidance to what all of these various entities might do next time they meet. The RBA is not meeting this week, but there is some inflation figures coming out of Aussie on Wednesday, so that will be interesting, because the Reserve Bank of Australia meets I think next week, first week of July, and markets divided. They're about sort of 60-40 in favour of no change, but we got a bit of a surprise from the Reserve Bank of Australia last time, and we've had plenty of other surprises lately. So, watch the space. The market does see more interest rate hikes coming in Australia, but they believe that they might just sort of skip this meeting and pause. But who knows what they'll do. But that CPI figure on Wednesday will be worth watching for that reason. What else have we got here in New Zealand? Oh, before we move off the US, the other thing that I think is going to be worth watching will be the annual bank stress tests that the Federal Reserve does. They do these every year, but they'll be particularly interesting given what we've seen in the US banking sector this year. So we've had the failure of several of those regional banks earlier in the year, and there's still ongoing concerns over risks around the banking system. So I think those bank stress tests will be probably watched a little bit more closely than they otherwise would. That's pretty much it globally. Here in New Zealand, it's another quiet week. We haven't got a whole lot on the cards, but we have got the ANZ Business Outlook survey for June, which is due at 1 o'clock on Thursday. That'll be interesting. Business confidence improved last month, so it's still some way below the long-term average, but it's the highest we've seen in about a year and a half, or close to a year and a half. So that's good. That's at the headline level. The own activity measure, which is the one that I always find more useful, also subdued, but it's the strongest we've seen since October last year. So, we've at least seen some stability in there. On the inflation front, what we've seen recently is pricing intentions from firms continuing to decline, going in the right direction, but still at much higher levels than we would like to see, or than the Reserve Bank would like to see. And wage growth is still very much something that is causing businesses a bit of grief, with that really tight labour market and those pressures on wages, which then sort of fuels broader price rises and inflation, and then means that the Reserve Bank has to do a little bit more, which causes higher borrowing costs and higher mortgage bills for everybody. So yeah, we'll be watching the detail of that survey for any indications about how things are tracking. Not a lot on the corporate front. Nothing here in New Zealand. A bit of a lull in corporate news flow, unless you get any corporate announcements you weren't expecting. We had one from E-Road obviously last week, so unless you get anything like that come out, but there's nothing scheduled. It's pretty much the same in Aussie. A couple of results coming out of the rest of the world. Nike got an earnings release on Thursday, so that will be interesting. Nike is obviously a very, very large global business and a very good one. H&M, Walgreens, Boots Alliance, Micron. So there's a few in there, but the reporting season isn't far away, actually. The quarterly reporting season will begin in the US probably the second week of July, so not long to wait. But this week it'll probably just be that Nike one that investors will be keeping an eye on. Right, that's all from me. The only other thing I was going to make mention of is the fact that I'm going to take a bit of time off over school holidays. One more week of school, then there's 2 weeks of school holidays, first 2 weeks of July. So I probably will skip 2 weeks of these week ahead sessions. So you won't get one of these in a week's time, and then you won't get the one the week after that either. Even if I take 1 week off, it's still, the weekend either side, which I'll also be taking off. So we'll take a short break. I have got one podcast that I will record later this week, maybe late in the week on something else. So, there'll be that, but then there'll be, a short break. So we will return, and we hope that you'll still want to listen in a couple of weeks' time. But until then, thank you, and we'll talk again soon.
For more insights, visit craigsip.com.